Okay, let's dive right in. Caterpillar CT dropped their Q3 2025 results October 29th, and bam, the stock jumps 13, maybe 14%.
Yeah, quite the reaction.
So the big question is why? Why such a huge surge when, you dig in and see some real profit pressures under the hood? That's what we're unpacking today.
It really is fascinating. A bellwether report, definitely. And these numbers, they didn't just meet Wall Street's expectations.
Yeah.
They really smashed them. It points to incredibly resilient demand.
Okay, let's hit those core numbers then, the ones that sparks that market rally. What were the Q3 headlines?
You got to start with the top line. Sales and revenues, an all-time record for them, $17.6 billion in a single quarter.
Wow, all-time record.
Yeah, and that's up 10% from the $16.1 billion a year ago. So strong growth there.
And the earnings, because that's always the key beat everyone's looking for, right?
Absolutely. Adjusted EPS, earnings per share, came in at $4.95. The analysts were looking for about $4.52, so it's a significant beat there.
Okay, 4.95 cents versus $4.52 expected. Solid beat.
Solid beat. Now, it's worth noting that 4.95 is actually a little below last year's adjusted number, which was $5.17. But, like you said, the market reacted to the beat against current expectations.
Right, expectations are key. And this record revenue, it came from solid demand across their main segments, right? More
Yep.
equipment sales to end users.
Exactly, of people actually using the machines. But the forward-looking piece, that's where it gets really compelling. That backlog number is just massive.
Ah, the backlog. Tell us about that.
It's another all-time record. Stands at $39.8 billion now.
39.8 billion.
Billion. That's a huge amount of work already locked in. It gives them incredible visibility for, the next several quarters. Really smooths out the typical cyclicality you see.
Yeah, that kind of buffer lets you sleep at night. Explains why the CEO, Joe Creed, was talking about sustained momentum and long-term profitable growth.
It absolutely does, operating with confidence. But as you hinted earlier, it wasn't all smooth sailing. Great top line, great orders, but we need to look segment by segment to see the cost pressures.
Okay, let's do that. Three main buckets in machinery, energy and transportation, or ME&T. Where should we start? Maybe the star performer.
Yeah, let's start with energy and transportation, E&T. That was a standout, no question.
How good was it?
Sales shot up 17%, almost $8.4 billion. And crucially, the profit followed suit up 17% as well, to about $1.68 billion.
So the margin held steady. That's pretty impressive with costs rising.
Exactly. Profit margin stayed right around 20%. It's just really stable.
What drove that? How did they avoid the squeeze hitting others?
So it was higher sales volume, definitely, and also favorable price realization. So they were able to pass on costs effectively there. But the really interesting part, power generation.
Power gen. What specifically?
Big demand for their large engines, specifically for data center applications. That was a major driver.
Hold on, data centers. So CAT-T's growth is being boosted not just by construction and mining, but by, the cloud and AI build-out.
Precisely. It plugs this traditional industrial giant directly into that, massive tech infrastructure growth curve. It's a different kind of demand cycle, potentially less cyclical. I think that's a big reason the market got so excited.
Fascinating. Okay, let's contrast that with construction industries, CI, buildings, roads, that kind of equipment. Sales were up.
Sales were decent, yeah, up 7% to about $6.76 billion. North America was strong, and the euro exchange rate helped a bit.
But the profit story wasn't as rosy.
Not at all. That's where you see the squeeze. Segment profit actually fell 7%, down to $1.38 billion roughly.
Fell 7% despite selling more stuff? How?
Two big hits. First, what they call unfavorable price realization that cost them $262 million. And second, unfavorable manufacturing costs another $174 million hit, and they specifically mentioned tariffs there.
Okay, let's unpack unfavorable price realization. Does that just mean their input costs, like steel or whatever, went up faster than they could raise prices on the final machines?
That's usually the main driver, yes. They couldn't fully pass along those rising costs, including tariffs, to the customer. So the margin takes a hit, they absorbed it.
And $262 million is a pretty big absorption. Now, what about resource industries, RI? The big mining gear, how did they fare?
Even tougher time for RI. Sales were only up slightly, about 2% to $3.1 billion. But the profit, that dropped sharply, down 19%.
Wow, 19% drop. Same issues as construction.
Exactly the same, just maybe more pronounced. Higher sales volume helped a bit, but it was swamped by $92 million in unfavorable manufacturing costs again. Tariffs flagged, and another $61 million hit from unfavorable price realization.
So outside of that hot E&T segment, especially the data center part, the other heavy equipment areas are really fighting cost headwinds.
Definitely. It really highlights the impact of those external pressures, even when underlying demand seems pretty solid.
Before we get fully into those tariffs, what about Cap Financial, the financing arm?
Quick look there. Revenue up 4%, just over a billion. Profit dipped slightly, down 2%. They had a bit higher provision for credit losses, some higher admin costs.
Anything worrying in the loan book? Are customers struggling to pay?
Doesn't look like it, actually. The key metric, past dues, remained really low, 1.47%. That's actually down from last year.
Yeah.
So while write-offs were up a touch, the overall portfolio looks healthy. Customers are managing.
Okay, good sign. Now, let's circle back to this tariff issue. It hammered profits in CI and RI. Just how big was this impact in Q3?
It was significant. The company said the net impact from incremental tariffs in Q3 was near the top end of their own estimate, which was $500 million to $600 million.
Wait, $500 million or more in one quarter, just from tariffs?
Just from the incremental tariffs, yeah. It's a massive number.
That's staggering. That's almost double the entire quarterly profit of the resource industry segment you just mentioned. Gone to tariffs.
Puts it in perspective, doesn't it? It really underscores how much this external, policy factor is directly hitting their bottom line.
And yet, despite that huge hit, they still generate a strong cash flow.
Incredibly strong, actually, which again speaks to the underlying operational strength. They generated $3.2 billion in free cash flow from the machinery, energy, and transportation segments. That's about $500 million more than last year's Q3.
So the core business is humming, even with this massive tariff anchor dragging on profits.
Exactly. And they finished the quarter with a very healthy cash balance, too, about $7.5 billion in enterprise cash.
That much cash, $7.5 billion, raises a question, though. If operations are strong but costs, especially tariffs, are hitting margins, why not invest more internally to boost efficiency or something? Why sit on so much cash?
It's a fair question. I think management's focus right now is very much on shareholder returns alongside maintaining flexibility. They sent $1.1 billion back to shareholders just in Q3.
How did they split that?
About $700 million in dividends and $400 million buying back stock. So while they have that cash cushion, the priority seems to be direct returns rather than, say, massive new capital projects right now.
Okay, disciplined capital return. Makes sense. Let's pivot then to the outlook. Given the strong Q3 record backlog, what's the guidance for the rest of 2025?
They nudged up the full-year outlook slightly. They now expect sales and revenues to be modestly higher than 2024. Before, they just said slightly higher. So bit more optimism there.
Okay, modestly higher sales.
Yeah.
What about services revenue?
That's expected to be ABBA flat compared to 2024.
And the elephant in the room, tariffs. What's the full year projection for that hit?
Still massive. They're projecting total net incremental tariffs for the full year to land somewhere between $1.6 billion and $1.75 billion.
1.6 to 1.75 billion. Oof.
Yeah. And this leads to that really interesting split in their profit margin guidance. It tells the whole story.
Explain that margin split. How are they guiding it?
Okay, so they're saying, look, without factoring in that huge tariff impact, our adjusted operating profit margin is on track for the top half of our annual target range. Basically, operationally, we're killing it.
Yeah.
But when you include that estimated $1.6 to $1.75 billion tariff hit, the margin guidance drops to near the bottom of the target range.
So they're explicitly telling the market, our underlying business is performing at the high end, but government policy is costing us potentially $1.75 billion directly off the profit line.
That's exactly the message. Very clear signaling. Operationally strong, policy headwind is severe.
And looking just at Q4, the final quarter, more tariff pain expected.
Looks like it, maybe the biggest hit yet. They expect strong sales growth versus Q4 last year, but they're forecasting net incremental tariffs in Q4 alone to be somewhere between $650 million and $800 million.
Wow, so another big chunk. Any other Q4 specifics?
Just a note on dealer inventory. They expect it to decline slightly in Q4 this year, which is different from last year when dealers cut inventory by a much larger $1.6 billion in Q4. So maybe a slightly more stable inventory picture now.
Okay, so summing this all up, it's a story of really impressive demand, especially in E&T, driving record results and that monster backlog. But underneath, you have these significant tariff and manufacturing cost pressures really hitting margins hard, especially in construction and resources.
That nails it. Resilience versus headwinds. That nearly $40 billion backlog gives them a strong cushion heading into 2026. But let's go back to that E&T driver. the data center demand you picked up on.
Yeah, that really stood out.
It connects CCANT to this whole AI infrastructure build-out, right? Which leads to a really interesting final thought, something for you, the listener, to consider.
What's that?
Is Caterpillar's valuation going forward going to be increasingly tied not just to the usual suspects, infrastructure spending, mining cycles, but also to this potentially less cyclical, massive global demand for energy to power AI and data centers?
Yeah.
Has a whole new long-term growth engine just been ignited for them, something worth watching closely?